Welcome back to Rockstock Channel. It is Wednesday, September 3rd, and we are excited to announce that we have taken on a new sponsor for the channel, USCF Investments. Today's interview is with John Love, the CEO of USCF, which manages more than a dozen commodity and alternative-focused exchange-traded funds. USCF, formerly known as US Commodity Funds, is perhaps best known for its flagship ETF, the United States Oil Fund, which trades as ticker symbol USO and is designed to track the daily price movements of the light sweet crude oil futures contract. But they have several other funds providing targeted and diversified exposure to hard and soft commodities, as well as a fund focused on battery metals and electrification, which is how I came into contact with John through the Fast Markets conference in June. John will share a bit of history of USCF and how it is different from some of its peers, in particular, its focus on investing in commodity futures. And then we'll discuss briefly four of the funds we think our viewers should be most interested in. First, a copper index fund. Second, a sustainable battery metals strategy fund. And third, a gold income fund. And fourth, a broadly diversified commodity fund. And with that intro out of the way, welcome for the first time, John Love. Please tell us a bit of your background and how you got involved in USCF, and then let's dig into your overall strategy and these four funds.
Well, thanks, Howard. Great to be with you and join you guys on the show. My background, I actually started working at a mutual fund firm. And while I was there, the founders had the idea to launch an oil ETF. And so I was helping with that early on in my finance career. We launched that ETF in 2006, and that's when the firm really came to fruition with USO. As you mentioned, that's our oil product. And we had a lot of success with that. So I was running the fund from day one and kind of had a lot of experience with that product, and then launching other products that we did over the next few years to the point where I was deeply involved in the firm and all aspects of it. In 2015, I was promoted to CEO. We had probably 12 funds at that point, and we've launched a number of products, tried a number of things since then. So in a brief nutshell, we've been around 20 years. Our focus is commodities and alternatives, and putting commodities and alternatives into ETFs and making it easier for investors to get exposure to particular either commodities or commodity themes or other alternatives.
All right, thanks for that, John. And just a reminder to all our viewers that USCF is a sponsor to this channel, but nothing you're hearing in this video is investment advice. Please, read the disclaimer and consult any, tax or investment professional, before making an investment in any of the products, discussed here. And but if you'd like to do some research, we'd highly recommend you visit their website, uscfinvestments.com. You could also find them on X at USCF Investments. And with that, I'll let Matt dig in with some questions.
Thanks, Howard. Okay, John, let's roll. So just, from the top down, how do you differentiate, or how is USCF differentiated in its funds from, other ETF providers out there in the market?
So I think a couple of ways. One, we really put a premium on innovation. I think if you look at our product suite, we were one of the first 300 ETFs. Right now, of the ETFs that are still in business, we were the 215th ETF in that list. So we're one of the early pioneers, not just of commodities in ETFs, but ETFs in general. There's now over 4,000 ETFs in the United States. So we've been there a long time. We were the third commodity ETF to launch. Prior to us, there was one broad commodity ETF that launched a few months before us. The gold ETF, GLD, which everybody knows, launched shortly before us. And then we were number 3 in the marketplace. So we launched the first oil product, the first natural gas product, first copper ETF. We also launched what we call the first third generation broad commodity ETF. I'll talk about that in a bit, I think, but that we think was extremely innovative as well. And then, if you look at our product suite right now, you can kind of divide it up in a couple different ways. One is you look at the single commodities, and then you can look at the broad or the thematic strategies. Another way you can do it is because our beginning was in oil, natural gas, fossil fuels, all those kind of things. We also kind of launched a what I call a barbell strategy. We have sustainable products on the other end of that barbell, and we know as this energy transition takes place, has been taking place, but continues to take place with ups and downs. That's a place we want to be, and we want to offset that carbon footprint a little bit with something on the other side. So those are a couple of ways we're differentiated. We're also probably smaller, nimble. We've got a team that's been in place, pretty steady team for a long period of time. And we're not well known as a firm, but our funds are very well known. When I have friends and neighbors mention tickers to me and don't realize that I'm the one behind those funds. So that's fun sometimes.
Cool. And I mean, if I'm an investor, why would I buy, for instance, a commodity ETF rather than buying a stock, or if I was really advanced, maybe a futures contract or something?
That's a great question. I'm glad you asked that, Matt, because well, one is we take the work out of it for you. If you are a sophisticated investor, you still have to deal with rolling your futures contracts. You have to deal with margin, a lot of things that can be a headache, even if you know what you're doing and you miss a date or a margin call or something like that. We take that out of the equation. For people that aren't as sophisticated or don't want to do that amount of work, we also make that easy for you. Another reason you'd want to own the commodity and not the stock is they're really very different investments. You look at something like an Exxon Mobil or an XOP ETF, which tracks energy stocks, or you track gold miners or copper miners. Those certainly have exposure to the price of the underlying commodities that they are, that's their business. But they also have exposure to the broad stock market and specific company fundamental factors, all of that kind of stuff. So their exposure to the commodity price itself is actually much lower than people think. It may be, in some cases as low as 12%, it may be 50, 60%, but they're also trading on these other things. So the beta of commodity equities to the stock market is a lot higher than in a lot of cases it is to the underlying commodity. So people used to buy natural resource funds, and those would invest in not commodities themselves, but in companies. And one other thing I'd say about that is the diversification factor, the benefit that commodities bring. You get that from the pure commodity exposure, not from the buying commodity equities. You get a little bit of it, but you do not get the same diversification benefit that you get by buying, actual oil, natural gas, copper, and so on.
On that point, there are two of the funds that we mentioned we're going to discuss here. One is the copper ETF, which is CPER, is the ticker symbol. And then there's the gold income fund, which is USG. I mean, that comment you made is that typically I'm invested in like a gold equity fund and a copper equity fund, thinking that, yes, I'm getting a high beta play to the copper price and the gold price. But sometimes earlier this year, just a few months ago, like the copper price rose, but my commodity, my copper ETF, barely moved. So the CPER fund I looked at as quite similar to USO. It's a bet on the near term copper price. It only has 3 holdings in it, right? The copper futures for December 2025, March 2026, and May 26. So it's a bet on the near term price, of copper. If you could just kind of discuss that one, if there's more to say than that, and also how does the USG Gold Income Fund, differ from some of the GLD you mentioned, as well as the gold equity funds that you referred to?
Sure. Well, let me start with copper CPER. That is that's the first copper commodity ETF. There were, as you mentioned, ETFs that traded in natural resources. I'm not sure the founding date of COPX, but COPX is well known, and that's a traditional way to get exposure. So exactly what you just said is a perfect example. In fact, it works both ways. So COPX, when copper, really took off, the copper commodity price earlier this year, COPX went up as well, but not as much. When you had these big leaps in price, CPER, or just the copper futures, rose along with that. Whereas COPX has different exposures, didn't rise as much. The reverse happens when we had a surprise in July when President Trump had been talking about copper tariffs for months and months, and then at the last minute decided that he wasn't going to tariff copper; he was going to tariff copper products, but he would leave pure copper out of that. And what that did, there was a premium on the price of copper that had built up in the U.S. copper contract versus London. So immediately, and that premium represented the one, people bringing copper over here to arbitrage copper between the U.S. and London, and two, it was representing that expectation of a tariff. Once that vanished in one day, copper dropped a lot. So you're going to get exposure when you buy the commodity ETFs that are investing in futures or in physical commodities. You're going to get exposure to that commodity price, whichever way it goes, as opposed to exposure to again the broad equity market and individual company fundamentals.
And John, just to confirm, so basically your instruments, your ETF instruments, they've only got exposure to US listed commodities, and I would say that that's quite a major differentiating factor, isn't it? Because most ETFs have got exposure to LME commodity prices as well.
We do have some LME in some of our funds. So on the two you're mentioning, copper, that is US, USG, US. But we do have some overseas exposure. But one thing that is consistent is all of the commodities we buy are priced in USD. So they're dollar-based commodities, and they tend to be, regardless of where they trade, we're going for whatever the benchmark contract is, the most liquid contract. Sometimes that changes over time, so we might shift from LME to COMEX or something like that. But it's basically whatever the most liquid contract is. That's generally what we're looking for.
Okay. Okay. And then on the gold fund, I read on your website, very interesting, that to contribute the income component of the fund, you sell options over the futures that you're holding. Can you just talk a little bit about that as a strategy?
Sure. So USG, as you know, there's been gold ETFs out. As I mentioned, it was the second ETF to launch, or commodity ETF to launch, was a gold ETF. A lot of people have launched competing products, and there's really two or three that have the majority of the assets. What we wanted to do is we looked at gold, and there's gold bugs. There's a lot of reasons to own gold, uh, aside from just other commodities, but it doesn't produce any income, like any commodity. And there are periods of time when gold is fantastic. This year is a perfect example, gold alone. But there's other periods where gold's flat, where gold declines over sometimes more than you get more than a decade bear markets. So you want to hold gold long term. We think maybe a better option is having a gold fund that tracks the price of gold, but also adds an option overlay, so you're producing income. The idea is when you're in those flat periods or you're in those declining periods, there's a little extra oomph added to your return. Is our hope. In fact, that even works when gold is going up. You're earning income as long as it's not on such a fast trajectory that the options get get called or go in the money. So, but generally over time, we did some studies of this before we launched, and it tends to it historically has been a better way if you're a long-term holder. And it's just those short periods where, maybe without the options, you catch a little more of the pop to the upside. But we think long term, having gold plus income is sort of a perfect mix, because you can't get that just holding gold alone.
Yeah. Okay. Howard?
Okay, that's great on those two funds, and copper and gold are very topical. Always topical to our audience, but not super hot of late. Have been the battery metals strategy fund, but nevertheless, we're aware of the Global X LIT, and Amplify has their BATT, and Van Eck has their REMX. But you have ZSB, the Sustainable Battery Metals Strategy Fund, which seeks total return by investing in metal derivative instruments and equities economically tied to the metals that are necessary for electrification. So we're going to flash up some of the holdings here, which include aluminum futures, copper, cobalt, zinc, lithium, and silver, but also owns some equities, including Albemarle, MP Materials, Aluka Resources, as well as some of the Chinese players, as well as Korean companies like Echo Pro, on the cathode side. So yeah, to talk about why'd you launch this strategy, and what why this is an attractive way to play electrification versus some of the alternatives.
Yeah, so ZSB, we're very proud of that strategy for several reasons. One, um, we, as I mentioned before, we have that sort of petroleum heavy side of the commodity space, and we wanted to branch into something that we think is, one, beneficial, but also two, um, there's hopefully a lot of upside in the coming years. So, we launched it, frankly, because we think that these commodities have a lot of upside potential in coming years and decades. We happened to launch when lithium prices were at their high. Lithium prices came down, so that's been a little tough, and investors have soured a little bit on the space. But we think that that will come back. Um, and then, what's different about this product from our competitors? There's really, I think, two main things. One is we have a higher exposure to what actually goes into a battery, or what actually goes into a charging station, or what actually goes into all this infrastructure that still has to be built out, and we believe will be built out, politics aside, over time. And we do that by looking at what goes into those things, like a battery, charging station, and so forth. What is most needed for the energy transition, and we base our weights on that. So we have a higher exposure to lithium and cobalt than our competitors. But we also, one way we achieve that is lithium futures and cobalt futures are growing. They've grown quite a bit over the last 3 years since we launched, but we were able to start with those futures in the portfolio. We also used exposure to miners that derive their income from those specific metals. So if we said, hey, look, we want a X% lithium weight, and we think there's not quite enough liquidity yet in lithium futures, we'll get exposure through these miners. Now, I talked about that not necessarily being um, the best way to get a pure commodity exposure, and that's true. But these are more focused companies on specific metals, and two, that's a way to get the exposure now, and then over time, as lithium and cobalt markets grow, we hopefully will add some more futures.
Well, I think what really stands out for me on this product, John, is that a lot of the ETFs out there, they've just got a bit of lithium, a little bit of cobalt, or they've got lithium producers or nickel producers or something. But what's really interesting for me in this ETF is you've got really everything. So you've got exposure to anode and cathode and electrolyte and separator, all the way through the battery supply chain. So if you genuinely want a way to play, the battery supply chain, this comes across as a fund where the managers have really done their homework in terms of what's actually in the battery supply chain, as opposed to just the funky things.
Precisely. Yes.
Sorry, a question I have for this fund, as well as the last fund we're going to talk about, the SDCI. which provides exposure. I find this one I don't have exposure to some of the stuff that's in this one. It's a broadly diversified commodity through investment and futures contracts and other commodity related derivatives instruments, including gold, gasoline, tin, crude oil, zinc, but also, cattle, soybeans, coffee, and aluminum. So could you describe this fund, but also in talking about both ZSB and SDCI, how much of this is actively managed, right? Like, are you making bets? Like right now, I don't know, is coffee good or soybeans good? And like, how do you, um, is there any active management here, or is it all, passive?
Sure. So there's no active management. There are systematic rules that we follow for both funds. SDCI tracks the Summerhaven Dynamic Commodity Index, and I'll tell you how that works in a second. ZSB tracks an internal quantitative system that we came up with, which is just like I mentioned. It's focused on what metals are important, and that to the the battery and the electrification chain. And we look at that annually and decide, okay, lithium is X percent of this of what's going into um, uh, products and things involved in the transition. So there's X amount of demand for lithium and relative demand for lead and silver and iron ore, you name it. And based on those weights, we rebalance once a year. So it's systematic. We use publicly available data to derive that, and then we make little tweaks just to make sure we're really representing that space. The idea being that we're not necessarily picking what's going to go up the most. We're picking what is most exposed to the energy transition. Back to SDCI, that one has we think a unique methodology. If you look at traditional commodity indexes over time, they're production weighted, they are liquidity weighted. The idea was, how important is a commodity to the global economy? For example, petroleum is going to be in a traditional index a very high weight. You're going to have a lot of oil, gasoline, those kind of things, because it's a huge part of the global economy. You're not going to have exposure to things like cocoa, which last year was up more than 300%. Some of those traditional indices don't have cocoa at all. Others may have it at a very small weight. What we did, we partnered with this firm, Summerhaven, in 2010. Actually, they launched their index in 2010. We launched a fund with them that is still in existence. It has a different tax treatment. SDCI was launched in 2017, and it doesn't have a K1. The older fund puts out a K1, but if you go to our website, USCFinvestments.com, you can find both under the broad commodity header. Most investors seem to prefer no K1, less hassle, so they go to SDCI. But that strategy, same strategy is in place for both funds. They both track the same index. And so what SDCI does, and what the index does underneath, is it looks at a universe of the 27 most liquid commodities, and it picks 14 at a time. So it doesn't pick the entire commodity universe, but it does pick something from every commodity sector. It makes sure we still have that broad diversification, and we equal weight the 14 commodities that we choose, so that on a monthly basis, we're basically giving you exposure, probably more exposure to these other stories that are out there besides the headline commodities like oil, gold, and so forth. And what that has done for us is, there's, just because crude oil is the most maybe important commodity in the world, there's no reason that it has to have the best returns. Cotton and cocoa and coffee, all these things have individual stories. It's all about supply demand. So we want sort of that more opportunities, more degrees of freedom, exposure to those different potential stories. And then we want to signal that we think picks on average the commodities that are more likely to outperform over time.
How does that work? So there are 27 of the most liquid, but you only invest in the 14 that you think are going to have the most upside.
Correct.
And is that right?
Exactly.
So how is that determined?
So that's a systematic process, and every month, what the index does is they look at those 27 commodities, and they pick the ones that are, I don't know, that have the highest amount of what's called backwardation or the least amount of what's called contango. And some people may be familiar with those terms, but they're basically, they describe something called roll yield. Roll yield can be positive or negative. I'm not going to get into that. If it's positive, obviously it can be a benefit to investors rolling futures contracts, which commodity funds have to do. But we think that signal, basically, whether the futures curve is rising, if prices get more expensive as you go out in time, or whether it's falling, prices get cheaper if you go out in time. We think that that is the market telling us something, and it gets into that supply demand equation. It's very difficult to you can look at supply, you can look at demand, but it's hard to predict what future supply demand are going to be. We think that the shape of the futures curve tells us when something is either scarce or market participants are worried that it's going to become scarce. So the steeper the curve in one direction, the stronger that signal is. So in very simple terms, we're essentially taking the market telling us this is what's scarce or likely to be scarce relative to the other commodities. And therefore, that something that's scarce has more likelihood of rising in the near term or long term than things that are abundant. So we're using that fairly simple signal to pick those commodities. And then, like I said, we have the diversification factor where we make sure if we've chosen the 14 contracts with what I'll call the most scarcity in that signal, and we're missing agricultural commodity, we'll kick out the worst idea or the worst ranked commodity from the 14, and we'll put in the best of the agriculture. So we always maintain that exposure to the broad sector. And what that does, that gives us high beta, or not high beta, but strong beta to traditional commodity indices. You're getting that exactly what you want in the commodity ETF diversification, but you're also getting what we think is potential for outperformance over time. And that has shown up in our results.
And that's reweighted every month.
Correct. Reweighted every month.
Okay, that's an important point. Even though it's not actively managed, it is every month taking market signals and adjusting. And so just for me to be clear, so the one that has the highest upward slope, Contango, right? The price should rise in the future. That's what you're putting into the fund more, and you're kicking out the ones where it's in backwardation?
The other way around, actually. So it's a little confusing, but Contango kind of maybe what you could think of as the normal market. If you're in a futures contract today and tomorrow's contract is a little higher, that makes sense because when you have a commodity, you have to store it, you have to insure it, transport it. There's all these costs. So, a commodity a month from now and 2 months from now, you should see something rising. When something goes into backwardation where it's getting cheaper, there's two things that happen, or two points to make here. One is that it's probably getting cheaper because sellers are having to incentivize people to buy further out the curve, and two, buyers want the front of the curve because they're thinking, I need this, I need the corn for my cornflakes, and so on. So to incentivize people to buy further out, the price goes down. What happens over time is if the spot price doesn't change, those prices that are cheaper rise up to spot over time. And so you're getting that extra gain. So even though the futures curve appears to be or is rising, that's actually something you don't want. You prefer not to roll into a higher price contract. You'd rather roll into a lower price contract and have that appreciate relative to spot each time. Not each time you roll, but over the holding period. Backwardation represents scarcity in our view a lot of the time, and that's what we're going for.
As the viewers may understand, I'm more an equity guy, not a futures guy. Rodney, our other partner, isn't here today, and he's had greater experience on the futures and derivatives. And I think Matt has studied the CME and the LME more than I have. But anyway, that's good for those like me who don't have so much experience in futures. This is a product, right, where you can get diversification, not only in that investment vehicle, but across a whole slew of commodities that you might not otherwise be paying attention to. And that leads to my last question, is just how is investor sentiment and funds flow, into USCF? Because under Trump, there's obviously been a big focus on reshoring of certain commodities. Obviously, drill baby drill, on oil, but oil price isn't very high. Um, so I think gold inflows are happening. Gold equities, uranium on the nuclear story. There's a lot of interesting stories here, but you as a U.S. based, the U.S. generalist investor is coming into a lot of individual equities that we talk about, regularly here. But I'm just curious, uh, from your perspective, are you seeing that? What's your comment about U.S. funds flow into commodities generally?
I think we're probably seeing a little different story in that people are looking for diversification a lot this year. That's one thing that stands out is with equity markets. One being at very high valuations and high prices. People are a little nervous and they're looking for the diversification factor, whether that be a specific commodity or broad commodities. I think that's a story that's resonating right now, especially when you had what happened in April with the Liberation Day tariffs. Everything took a hit, but commodities did not fall as much as equities, and they recovered quicker. So I think, yeah, year to date, S&P is up about 9% or so. SDCI is up about 16%, give or take a little bit any given day. But we're seeing not only the desire for diversification, but the outperformance. And then I think more to your point, when people look at individual commodities, if they're knowledgeable about individual commodities, that's when they might look at something like CPER, and they kind of look. There might be more short-term traders in that, or there might be people looking at what's hot. So I think with broad commodities, we see sort of a steady, flow coming in at a rate we haven't seen in SDCI before. So that I think tells that diversification story. And other products are up and down, and sometimes the price of a commodity can be down, and we'll get flows into that because people are thinking that that might be a good entry point. And sometimes it is. Sometimes you can have markets keep going lower. So you want to do your homework, and if you're trading individual commodities, know what you're talking about. But that's kind of what we're seeing in terms of flows.
And I mean, are you seeing a lot of people sort of, I mean, we see it a lot in the press at the moment. People are sort of calling for a new super cycle, saying that commodity should be a core part of investment allocations. Are you seeing sort of interest in that as a thematic?
We are, and it seems like perhaps it's time for one based on a couple of things. One, electrification. Two, you already had need for commodities in infrastructure, but now things like copper and other things are needed for AI data centers, and the world's energy needs are going up. Uh, and even though there might be plenty of fossil fuels at times relative to demand, demand for everything seems to be rising. And then you have emerging markets. You look at India, where they're building out more and more infrastructure. The demand for commodities is fairly high. So I think it's hard to say what happens in the near term, whether if we have a soft patch in the economy, global economy. But I think long term, you can make a case looking over history that commodities should be a core part of your portfolio. They have similar returns to stocks and bonds over the long term, similar volatility, but they're diversified. Um, so I think after the 2010s, when commodities didn't do so well, we're seeing them coming alive in pretty strong ways, and that may continue and pick up as people use more and more stuff.
Fingers crossed, people will start to use more and more stuff. I mean, I think, one of the things for commodities, particularly in the 2010s, was that obviously we're moving from the manufacturing-based economy to more of a services-based economy, and technological innovations. People were using less commodities and everything in manufacturing, in goods. Our lives moved more services as well. we don't have DVD players and CD players anymore. We listen to streaming. So I think, hopefully the world got that out of its system over the last 10 or 15 years, and we go back to an environment where we have to invest in infrastructure, we have to invest in power generation, we have to invest in these things which are heavy in commodities. And of course, that's great for a commodities fund.
Exactly. I couldn't have said it better.
Okay, thank you very much, John. We really appreciate that overview of USCF and the four funds: CPER, ZSB, USG, and SDCI. Our viewers are going to be hearing more about each of these funds in each interview, as USCF has now joined Rockstock Channel as a sponsor. So, really appreciate the relationship, and look forward to interviewing you again sometime in the next couple of months.
Thank you very much for having me. Glad to be a sponsor and be on the show with you guys. So really appreciate it, and look forward to talking more.